Hi, I'm Kate Miller and welcome to Property Focus. Making headlines this week, natural disasters take a hit on the national property market and investors and home buyers turn their backs on fixed rate home loans. But first to our lead story. Units and apartments are set to offer investors lucrative returns, with a new report forecasting medium and high density dwellings to dominate the Sydney market in the years ahead. After accounting for around half of total dwelling activity in the 1990s, a new report from BIS Shrapnel shows medium and high density dwellings now represent just over 60% of the Sydney market, and this trend is set to continue. Speaking with Property Focus, BIS Shrapnel Managing Director Robert Mellor said the shift in demand towards higher density dwellings was driven not only by supply and affordability constraints, but equally changes in demographic preferences at both ends of the market.
So the younger generation, the under 35s, are more likely to want to live in a medium density or high density apartment than would have been the case, say, 20 years or so ago. Coupled with those retirees or empty nesters, maybe under 65, who are contemplating the freedom of no children and are deciding that rather than live in the big home for the next 10 years or whatever, maybe it's time to trade down to something a bit smaller and that they can manage their lifestyle rather than maintaining a large property.
A spate of natural disasters has taken a hit on the property market, with the RP Data Rismark House Price Index recording its worst monthly result since it commenced in 2005. According to the index, capital city values slumped 1.6% in January, while rest of state markets declined 1.2%. Tim Lawless, RP Data Director of Research, said the result reflected very weak sales volume levels and there was no need for investors to panic.
The flooding in Queensland, the natural disasters and so forth, we are working off quite a significantly smaller sample size, which may introduce some volatility into the numbers. So our advice is, before we start pushing the panic button for homeowners, let's have a look at the results for next month. We will see January's figures revised, either upwards or downwards, who knows, but probably upwards. And we'll also start to see what's happening in February. We'll get the preliminary results for Feb, and we should start to see some sort of a trend for how 2011 is unfolding.
Mr. Lawless said capital growth would be sluggish for the foreseeable future, and property investors with a long-term approach would reap the best rewards.
I think investors who are looking to buy into the market now really need to have a long-term strategy in mind, buying strategically, making sure they're buying in a very decent location, and also buying to maximise their rental yield in the immediate future, because rents are going to be going upwards during 2011, probably 5 or 6% over the year, I'd have to presume, which will certainly impact on rental yields, and investors who can maximise their rental yield and position for growth over a 5-10 year period should be a fairly successful strategy.
And Australians' love affair with fixed interest rates appears to have lost some of its fizz, with one mortgage broking group reporting a decline in the number of fixed rate loans taken out by customers in February. 10.7% of home loans approved for Mortgage Choice customers in February had a fixed interest rate, compared to 15.3% in January, the first decline since July 2010. The recent spate of variable rate promotions to come out of the new bank battle for business was a likely cause for the shift, Mortgage Choice spokesperson Christy Shepherd said. And that's what's making news this week. Don't forget, if you're a Sydney-sider, listen out for the smart property investment ads now playing on Triple M, promoting the March issue of the magazine Cashflow Kings, which is on newsstands now. If you haven't already, pick up your copy today. Until next week, I'm Kate Miller. See you soon.